So how does the Big Beautiful Bill affect real estate? Big tax changes are coming, and the Big Beautiful Bill is the biggest tax shift since 2017 when the Jobs Act was approved. If you're buying or selling real estate this year, you're going to need to know what the Big Beautiful Bill means and how to maximize your deductions so you don't pay tax. By the end of this video, you're going to understand what the Big Beautiful Bill is, how to utilize it and maximize your losses, and what bonus depreciation Section 179 is, and the investment strategies around the Big Beautiful Bill. So check out this video. All right, so the Big Beautiful Bill passed July 3rd with the current administration. Big win for real estate investors. So what does it mean? Well, it means 100% bonus depreciation is back. Why is that great? Well, as a real estate investor, bonus depreciation helps you accelerate losses. Losses accelerated means deferring tax. So the more income you bring in, the more losses you need to offset that income. And we're talking about passive income from real estate and passive losses from bonus depreciation generated from commercial real estate or real estate in general. So right now, the Big Beautiful Bill approved from 2025 to 2030 that 100% bonus depreciation is in effect. After 2030, it drops back down to 20%. So a recap of what bonus depreciation is. Well, when you buy a real estate property, you are forced to depreciate it. That is an IRS law. If you don't use it, you lose it, but you can use it and you should use it. And when you use it, you can break the building down into components. So 3, 5, 7-year, 15-year life property, shorter life property. We're talking property improvements. So those improvements can be accelerated. Those can go into the bonus depreciation bucket, and then you can accelerate those year one now. So all the depreciation that you would have took over 7 or 15 years, you can now maximize the first year of owning that investment. So this just means bigger write-offs for real estate investors. There's a part of the bill that allowed for a boost in depreciation for Section 179 property. Section 179 allows immediate expensing of specific equipment and property improvements. This covers HVAC, plumbing, electrical, appliances, office build-outs, furniture, short-term rental upgrades. This is especially powerful for owner-developers, value-add investors, anyone investing in real estate that's making improvements to properties. If you combine the Section 179 deduction with the cost segregation, that's going to give you the most amount of depreciation possible in the first 1 or 2 years of owning the asset. So cost segregations are more valuable than ever. Find a qualified cost segregation study engineer. In the comments below, I'll leave a link for who we use, and that person is going to be worth their weight in gold. A typical study could range anywhere between $3,000 and $10,000, depending on the type of commercial property, or possibly more. But it's not a huge expense when you look at the benefit that you generate from it. With 100% bonus back, you want to utilize as much of that depreciation as possible so that you can offset taxes. If you don't use all that bonus depreciation in year one from passive income that you generate or from a capital gain, you can use it carrying forward. In all future years of real estate distributions or passive income that comes in will still offset until you run out of that total depreciation allowance. This is a big benefit because now you're not paying 37% on that income coming in, and you're able to reinvest that or spend it and enjoy it instead of paying it each year in taxes. But the real key is to keep reinvesting that cash flow into more compounding growth real estate assets, ideally, and then being able to grow that wealth rather than each year cutting that balance of 37% of that income coming in and then diminishing the compounding effect on the returns of your capital. So let's look at an example. Say you have a $2 million commercial real estate building acquisition. The cost segregation study identifies $500,000 of eligible items to depreciate. That's a very conservative amount, and you typically can get more, possibly up to $1 million of depreciation on that asset. But that's a $150,000 to $300,000 savings that year from an investor who can use those losses to offset income that's already coming in. This is important to look out for because if you're a limited partner and you're investing in real estate funds or in real estate partnerships, you want to find out how much depreciation do I get with this investment. And at my firm, Patriot Holdings, we allocate all the depreciation losses to our limited partners. So they typically can get 1-to-1 ratio. They invest $100,000. They would get a minimum of $100,000 in passive losses that year. And sometimes it's gone up to 200% or $200,000 of losses in that year. It just depends on the assets that the partner's buying and how they utilize leverage, meaning bank debt, on that asset so that the equity that they put in gets the most amount of depreciation possible because there's the most amount of improvements or buildings that you can depreciate on the ratio of equity invested in the asset. So remember, a key tip is as a real estate professional, you can use the passive losses to offset active income. This is an outstanding strategy for any real estate investor. Now, you don't need to be a realtor to be a real estate professional. If you have a spouse, you can file jointly on your tax return, and one of you would have to put in 750 hours of qualified real estate activities. That would qualify you for real estate professional status. That unlocks a lot of creativity around taxes. Now you're able to offset earned income that you're bringing in from a business and portfolio income from stocks, bonds, interest loans that you're lending out to other real estate operators. Any other form of income can now be offset with those passive losses generated from real estate. This is a key strategy that helps you offset all the other forms of income, and you can only do that by having real estate professional status. So tax planning is now a weapon again. We have this tool at our disposal. This bill brings 5 years of certainty that we know we can generate large passive losses that can help us navigate our real estate portfolios. So what that means is we can now aggressively look at acquisition strategies because of the certainty that the loss is going to be coming. We can look at selling assets because now when we sell or exit an asset and pick up the capital gain, if you can acquire property that will generate enough passive losses from this depreciation, the bonus depreciation, you can now offset the majority, if not all, of the capital gain and still own a real estate asset without paying tax and deferring it farther down the road. And then also, during this period of time, when you want to exit an asset and you've depreciated it fully, you can still tap into the 1031 exchange strategy, where after there's no depreciation left and the basis of the property is at a bare minimum, now you can 1031 exchange into the next investment property, again deferring taxes and helping you still build a larger real estate asset base. In short, this means investors can get back on the offense. We can start using real estate as a tool, as a key tax strategy to help continue to compound wealth and own larger and larger assets. And as the economy keeps inflating, more dollars keep coming in. That means hard, tangible, useful assets like real estate will continue to go up in value. Yes, there's market fluctuations, but the name of the game is earning income and then generating returns from that income in safe, consistent, durable real estate assets. That's what we're acquiring, and that's the game that will continue to win as inflation continues to drive up asset values. So the bottom line is now we have a window of time to take advantage of these tax benefits. We have 5 years. Current real estate owners now have the certainty that if they have an accelerated depreciation, they can go get a cost segregation study and they can do it now. You don't need to do it in the first year you own a property. If you've owned a property for 3-4 years, you can still utilize the cost segregation study and now maximize bonus depreciation in this year and help offset taxes. And then lastly, after you've tapped out the depreciation and maximized it and you're ready to sell the asset in the next 5 years, you can use the 1031 exchange, and then you can look to invest in a TIC or a DST or find another property that you're going to acquire through the 1031 exchange and now continue to have a larger asset base and generate more passive income. If you do have questions on 1031 exchanges or how to invest a 1031 exchange into a real estate fund, feel free to reach out to my company, Patriot Holdings. I'll put my contact info in the comments below. But there are strategies actually to do that if you're ready to step away from actively managing your commercial real estate investments. So now that you know that bonus depreciation is back and the big beautiful bill gave commercial real estate owners a 5-year window for tax certainty so we can plan around taxes. Check out the next video about being a real estate professional. What are the qualifications? When don't you qualify? And how do you maximize that professional status to be sure to tax plan and utilize all the benefits for commercial real estate and real estate investors in the tax code?